Welcome to the Cryptohopper Crypto Trading podcast, where we help you become a better trader. Whether you're new to crypto or a seasoned pro, this podcast is for you. Tune in to hear from industry experts and check out cryptohopper.com for our world-class automated trading bot. In this episode, we have Cryptohopper's lead technical analyst discussing crypto investment risk management strategies. Subscribe to stay up to date on the latest crypto trading tips and insights.
Hello everyone, I hope you're all doing great today. My name is Mihai and I'm the main technical analyst at Cryptohopper. I am glad to be here with you today on our Cryptohopper podcast. Today we'll be talking about risk management in the cryptocurrency market. Managing risk in the cryptocurrency market is essential for any investor looking to navigate the highly volatile and unpredictable nature of the market. One of the most important steps in managing risk is understanding your risk tolerance. Risk tolerance is the level of risk that you are comfortable taking on as an investor. It can vary from person to person and it depends on your financial situation and investment goals. Understanding your risk tolerance can help you make more informed investment decisions and avoid taking on too much risk. It's important to note that risk tolerance can change over time. For example, an individual who is just starting to invest may have a lower risk tolerance than someone who has been investing for a longer period of time. Similarly, an individual who is closer to retirement may have a lower risk tolerance than someone who is just starting out their career. Your risk tolerance can also be affected by external factors such as the overall market conditions and personal circumstances. Risk tolerance can be measured in a number of ways. Some investors may use a self-assessment quiz or a questionnaire to determine their risk tolerance. Others may use a combination of financial metrics such as their net worth, income, current debt levels to determine their risk tolerance. Once you have a clear understanding of your risk tolerance, you can use this information to make more informed investment decisions. For example, if you have a high risk tolerance, you may be more comfortable with investing in high risk, high reward opportunities. On the other hand, if you have a low risk tolerance, you may be more comfortable with investing in low risk, low reward opportunities. In short, understanding your risk tolerance is an essential step in managing risk in the cryptocurrency market. By understanding your risk tolerance, you can make more informed investment decisions and avoid taking on too much risk. However, it's important to remember that risk tolerance is just one aspect of risk management, and it should be combined with other risk management strategies to maximize your chances of success in the cryptocurrency market. Thus, let's take a look over at other risk management strategies, starting with diversification. Diversification essentially means to spread your risk across different types of cryptocurrencies and projects to minimize the impact of a single investment failing. Diversification is a key strategy when it comes to managing risk in any investment portfolio, and this is especially true in the world of cryptocurrencies. With the crypto market known for its volatility, spreading your investments across multiple assets can help protect your portfolio from significant losses. One way to diversify your crypto portfolio is to invest in a variety of different coins and tokens. For example, rather than putting all of your money into Bitcoin, you could also invest in Ethereum, Litecoin, and other leading cryptocurrencies. This can help to spread your risk across different assets and reduce the impact of any one coin's performance on your overall portfolio. Another alternative is to have a variety of strategies. As I mentioned earlier, you can buy and hold different coins, and you can also use a number of different strategies. For example, you can make a strategy that trades based on trend following indicators that is great when the market is in an uptrend. Additionally, you can also have a strategy that is great at scalping when Bitcoin is stable. Lastly, you can have a strategy that trades futures and shorts Bitcoin. Doing this, you will be able to diversify and profit in any market scenario. Another way to diversify in the crypto market space is to invest in different types of projects. Some investors prefer to focus on established high market cap coins like Bitcoin and Ethereum, while others may choose to invest in newer, more speculative projects that have potential for higher returns. By diversifying in this way, you can potentially capture a wider range of returns and reduce your risk. It is also worth noting that diversification doesn't just mean spreading your investment across different assets. It also means spreading your investments over different platforms, exchanges, and wallets in order to minimize the risk of losing access to your assets. This also helps in case of an exchange collapsing, like what happened to FTX recently. In conclusion, diversification is a crucial strategy in the crypto market as it can help to spread risk and protect your portfolio from significant losses. By investing in a variety of different coins and tokens, as well as different types of projects and strategies, you can potentially capture a wider range of returns and reduce your risk. With diversification out of the way, let's talk about another risk tolerance method, namely the DCA, or dollar cost averaging. DCA can be a safer approach than going all in on a single investment or on a single trade in the world of cryptocurrencies. By buying more of an asset as the price falls, it can help to manage risk and potentially increase returns. When you go all in on a single investment, you are putting all your eggs in one basket. That means that if the price of the asset falls, your entire investment is at risk. On the other hand, by using the dollar cost averaging strategy, if the price falls, you are buying more of the asset at a lower price, averaging your overall cost basis. Additionally, by using the DCA strategy, you are not trying to time the market, which is a difficult task even for professional traders. By investing a fixed amount as the coin falls, you are taking a long-term approach and not trying to predict the short-term price movements, which can help reduce risk. It's also important to keep in mind that the cryptocurrency market is known for its volatility and prices can fluctuate greatly in a short period of time. So before applying the strategy, it's essential to do your own research and have a clear understanding of the coin or token you're investing in and the market conditions that may affect its price. While in most cases DCA can reduce the risk of an investment, if used badly, it can lead to serious losses. For example, if you keep buying a coin that is dropping, it can also happen that it never bounces back. This happened to FTX and Luna this year. Therefore, you should always have a maximum amount that you are willing to risk on any particular coin in order to minimize the amount that you can use. In conclusion, the DCA investment strategy can be a safer approach than going all in on a single investment in the world of cryptocurrencies. By investing a fixed amount at regular intervals regardless of the price, it can help to manage risk and potentially increase returns. It's essential to do your own research and understand the coin or token you're investing in and the market conditions that may affect its price before applying this strategy. Also, it's essential to set a max amount that you're willing to invest in any coin. Well, this takes care of the DCA. Let's now head on over to the next risk management technique, namely the stop loss orders. Basically, implementing a stop loss order will help you by automatically selling your investments at a predetermined price in order to limit your losses. Stop loss is a risk management strategy that is commonly used in the world of investing, including cryptocurrencies. It involves setting a specific price at which you will sell an asset to limit your potential losses in a potential downturn. The basic idea behind the stop loss is to protect your investments from a significant loss. For example, if you bought a cryptocurrency at $10,000 and then set a stop loss at $9,000, it means that if the price falls to $9,000, your position will automatically be sold, limiting your potential losses to 10%. While losing 10% on a trade may not be fun, it is much better than losing 30, 50, or even your entire investment in a severe crash. Therefore, the stop loss is a useful strategy for managing risk in the crypto market, as it can help to protect your portfolio from significant losses. By setting a stop loss, you can prevent yourself from holding on to an asset that is rapidly losing value and instead exit the position before your losses become too great. It's also worth noting that stop loss orders can be placed in different ways, such as a stop limit order, stop loss market order, and trailing stop loss order. Each one of them has its own specific characteristics and uses. A stop limit order is a type of order that combines the feature of a stop order and a limit order. It is used to limit the loss on a position. In the context of the cryptocurrency trading, a stop limit order allows the trader to set a stop price and limit price for a particular cryptocurrency. Once the stop price is reached, the order becomes a limit order, which will execute at the limit price or better. This type of order can be useful for managing risk and ensuring that trades are executed at a specific price, even in volatile markets. However, it also carries its own form of risk. That is because it is a limit order. Therefore, it is possible that if the price is moving too fast, it will not get filled, and the price will drop even further. A stop market order, on the other hand, is a type of order that combines the feature of a stop order and a market order. In the context of cryptocurrency trading, a stop market order is used to enter or exit a position at the best available market price once a specific stop price has been reached. When the stop price is reached, the stop market order is triggered and converts into a market order. A market order is an order used to buy or sell a cryptocurrency at the best available current price. Stop market orders are generally useful in volatile markets where the price can fluctuate rapidly. Stop loss market orders are very helpful as it guarantees you'll get filled when the price reaches a certain point. While you're not guaranteed to sell at exactly that price, you'll at least be able to sell it and make sure you're not holding on to a big losing position. In conclusion, stop loss is a risk management strategy that can be useful in the world of cryptocurrencies. It helps to protect your investment from significant losses by setting a specific price at which you will sell an asset. Another useful risk management strategy derived from the stop loss is the trailing stop loss. Thus, let's talk about it a bit more. A trailing stop loss is a variation of the traditional stop loss strategy that is commonly used in the world of investing, including cryptocurrencies. It involves setting a specific percentage or dollar amount that trails behind the current market price of an asset rather than a fixed price. On some platforms, Cryptohopper included, you can also set up the price at which you want to arm your trailing stop loss, or in simpler words, the price at which you want to activate your trailing stop loss. The basic idea behind the trailing stop loss is to protect your investment from significant losses while also allowing for some potential upside and to cash in your positions when you are winning. For example, if you bought a cryptocurrency at $10,000 and set a trailing stop loss 5% and arming it right away, it means that if the price falls 5% below your original purchase price, your position will automatically be sold, limiting your potential losses. However, if the price of the asset goes up, the stop loss will also move up, following the price, allowing you to lock in some of the profits while protecting your investment. This strategy can be particularly useful in the crypto market as it allows you to adjust your stop loss as the market moves, instead of having a fixed stop loss. However, it is very important to keep in mind that if your platform has an arm trailing stop loss parameter like Cryptohopper does, you should also set up a regular stop loss. That is because if, for example, you set your trailing stop loss to arm at 1%, and in the case that you bought a coin and it never reaches 1%, but instead just crashes right away 30%, your trailing stop loss will essentially be useless. In this case, you will want to also set up a regular stop loss. In conclusion, trailing stop loss is a risk management strategy that can be used in the world of cryptocurrencies. It helps to protect your investments from significant losses while also allowing for the potential gains by setting a specific percentage or dollar amount that trails behind the current market price of an asset. When using a trailing stop loss, it's essential to use it in conjunction with other risk management strategies such as a regular stop loss in the case that you have set up a percentage to activate it. Let's now move away from stop losses and see how trading with a bot can minimize risks. Trading with a bot, such as the Cryptohopper bot, can be an effective way to manage risk in the world of cryptocurrencies, as bots are not subject to emotions and can execute trades based on pre-programmed rules and algorithms. One of the main advantages of using a bot for trading is that it can help to eliminate the emotional biases that can impact human traders. Emotions such as fear and greed can cause traders to make impulsive decisions, which can lead to losses. Bots, on the other hand, can execute trades on pre-programmed rules and algorithms without being influenced by emotions. Another advantage of trading with a bot is that it can help to increase consistency and discipline in your trading. Bots can execute trades based on specific rules and conditions, which can also ensure that trades are executed in a consistent manner. This can be particularly useful for traders who have a hard time sticking to a specific strategy. Additionally, by using a trading bot, you can also keep an eye on the market 24/7, which is impossible for human traders. The bot can execute trades and monitor the market even when you are far away from your computer. It's important to note that while trading with bots can be a useful tool for managing risk in the crypto market, they are not without their own risks. It's essential to check your bot every day to ensure that it is trading the way it should. Additionally, it's always a good idea to have a clear strategy and to test the bot on a paper trading account, which we also provide before using it with real money. Or if you want to test it in a more realistic environment, use the bot with real funds but less than what you would normally invest just to test it out. In conclusion, trading with a bot can be an effective way to manage risk in the world of cryptocurrencies. Bots can eliminate the emotional biases, increase consistency and discipline, and keep an eye on the market 24/7. However, it's essential to do your own research, understand the risks involved, and have a clear strategy before using a trading bot. Now that we have a more clear picture of how trading with bots can help us manage risks, let's talk about managing your position size. Managing your position size is an important aspect of managing risk in the world of cryptocurrencies. Position size refers to the amount of money you are willing to invest in a particular coin or token, and it's an essential factor to consider when determining your risk tolerance. One of the main advantages of managing your position size is that it can help to limit your potential losses. For example, if you only invest a small percentage of your portfolio in a particular coin, the potential loss from that coin will also be small. By contrast, if you invest a large percentage of your portfolio in a single coin, the potential loss will also be large. The same goes for each time you trade. If you invest a lot of money on each trade, you can risk losing a lot each time. On Cryptohopper, we help you manage this risk by helping you set your position size as a percentage of your account. We have also built in the possibility of choosing a maximum dollar amount that your bot can use. Thus, for example, if you have a $10,000 account, but you only want to trade with $1,000, you can set $1,000 as the maximum amount on Cryptohopper. Another advantage of managing your position size is that it can help you increase your overall returns. By spreading your investments across multiple coins, you can potentially capture a wider range of returns and reduce the impact of any of one coin's performance on your overall portfolio, such as a coin crashing completely like FTT or Luna. And it's also important to keep in mind that managing your position size is not just about limiting your potential losses. It's also about maximizing your potential returns. It's important to find the right balance between risk and reward. In conclusion, managing your position size is an important aspect of managing risk in the world of cryptocurrencies. By limiting the amount of money you invest in a particular coin, you can limit your potential losses and increase your overall returns. It's essential to find the right balance between risk and reward when determining your position size, and using the sizing tool can help you with that. While managing your position size is very important to keep your losses small, what if you do not have to take those losing trades in the first place? The best option is to avoid losing money in a bad market is to use technical indicators to filter out trades that are less likely to succeed. Let's see how we can do that. Using technical indicators such as the MESA, or also known as moving average with adaptive acceleration, and parabolic SAR as a filter in your strategies on Cryptohopper can be an effective way to manage risk in the cryptocurrency market. The MESA indicator is a moving average that uses adaptive acceleration to identify trends in the market. It can be used to confirm the direction of the trend and help you determine when to enter or exit a trade. The parabolic SAR is a trend-following indicator that uses the parabolic curve to identify potential reversal points in the market. It can be used to confirm the direction of the trend and help you determine when to enter or exit a trade. Using these indicators as a filter in your strategies can help ensure that you are only trading in the direction of the trend. This can help reduce the risk of trading against the trend and potentially losing money. When using these indicators, it's important to remember that they are not perfect, and you should not rely on them alone. It's important to combine them with other forms of analysis, such as fundamental analysis of the projects and overall market conditions. You can find more about these indicators by listening to our podcasts or looking them up in our documentation, where we explain in detail how both indicators work on Cryptohopper. Just like doing your own research on these indicators can help you become a better trader, doing research on the market can help you manage your risk more efficiently. When we talk about research, we mean carefully analyzing and evaluating the projects you are considering to invest in, including the team behind the project, the technology, and the market demand. Researching very carefully the coin or token you want to invest in is a crucial step in managing the risk in the cryptocurrency market. This type of research is known as fundamental analysis, and it involves looking at the underlying technology, team, use case, and the overall market conditions of a coin or token. When researching a coin or token, it is important to consider these aspects. First, the technology behind the project. Is the technology well established and widely used, or is it a new, unproven concept? Second, the team behind the project. Are the team members experienced and reputable in their field? Third, the use case of the coin or token. Does the project have a clear and realistic use case? And finally, the overall market conditions. How does the coin or token perform in comparison to similar coins or tokens in the market? By researching a coin or token very carefully, you can gain a better understanding of the potential risks and rewards associated with investing in it. This can help you make more informed investment decisions and ultimately help you manage risk in the cryptocurrency market. In addition to your own in-depth research, there are several other ways to manage risk in the cryptocurrency market. Keeping yourself up to date is one such managing risk technique. In short, keeping yourself updated means that you are up to date with the latest crypto trends, news, and regulations. Keeping yourself updated with the latest crypto trends, news, and regulations is an important aspect of managing risk in the cryptocurrency market. The crypto market is highly dynamic and can be affected by a variety of factors, including changes in government regulations, new developments in technology, and shifts in investor sentiment. By keeping yourself updated, you can gain a better understanding of the current market conditions and make more informed investment decisions. This can help you identify potential risks and opportunities and adjust your investment strategy accordingly. Some ways to keep yourself updated include 1. Following cryptocurrency news sites and blogs. 2. Joining online communities and forums related to cryptocurrency. 3. Subscribing to crypto-related newsletters. And finally, following crypto influencers on social media. It's important to note that keeping yourself updated on the latest crypto trends, news, and regulations is an ongoing process and should be an integral part of your risk management strategy. A cryptocurrency blog, article, or newsletter can be a useful resource for learning about the latest crypto trends, news, and regulations. We send a newsletter every week and provide in-depth analysis and commentary on the latest developments in the crypto market, as well as information on government regulations and policies. As always, it's important to consult multiple sources, and you should never base your investment decisions based on a single source. Therefore, please consult other sources apart from us. Moving on to another risk management technique, and we have hedging. Hedging is one of the most effective ways to manage risks. Hedging is a risk management strategy that involves taking an offsetting position in a separate asset to offset the potential losses in the original investment. In the cryptocurrency market, hedging can be done in a number of ways, including diversifying your portfolio using derivatives such as options or futures, or investing in traditional assets like stocks or bonds. Diversifying your portfolio is one of the most straightforward ways to hedge in the cryptocurrency market, and we have already covered it, so let's talk about the others. Another way to hedge in the cryptocurrency market is through the use of derivatives such as options and futures. These financial instruments allow investors to take a position on the future price of a coin or token without actually owning the underlying asset. This can be an effective way to limit potential losses while still having the opportunity to profit from price movements. In addition to diversifying your portfolio and using derivatives, investing in traditional assets can also be an effective way to hedge in the cryptocurrency market. Traditional assets like stocks, commodities, or real estate are not all correlated to Bitcoin, thus it reduces your investment risk. It's important to note that hedging is not a perfect strategy and can also have its own set of risks. It's important to carefully research and understand the different hedging options available and how they fit in your overall investment strategy. For example, futures and options are leveraged products and can bring great losses if you overuse the leverage. In addition, it's important to keep an eye on the market conditions and regulations, as they can change rapidly and affect the performance of your investment. In short, hedging strategies such as diversifying your portfolio, using derivatives, and investing in other assets can help reduce the overall risk of your investment and protect against potential losses. Last but not least, in fact most important, is having a plan. Having a clear plan of your investments is perhaps the most important part of managing the risk of your investments. We tend to become more emotional and make a lot more mistakes when trading if we do not have a clear plan. That is because we don't know what to do and we don't know where we are heading. A plan for your investments should include your investment goals, risk tolerance, entry, and exit strategy. Having these elements clearly defined can help you make more informed investment decisions and ultimately help you manage risks more efficiently. Investment goals are the reasons why you are investing in the cryptocurrency market in the first place. They can be short-term, such as making a quick profit, or long-term, such as building a diversified portfolio for retirement. Having clearly defined goals can help you make more informed investment decisions and stay focused on your objectives. Having an entry is essential, as otherwise you can fall victim to FUD. FUD stands for fear of missing out. If you do not have a clear entry point, then you might start entering the market irrationally for fear of missing out during a strong rally. This can be very damaging because you may be entering at the top of an uptrend. The exit strategy is the plan for selling or liquidating your investments. It can include taking profits at a certain price level, cutting losses at a certain level, or holding them for a long term. Having clearly defined exit strategy can help you manage risk more effectively by providing a plan for exiting your investments if they do not perform as expected. Having a plan for your investment is a crucial step in managing risk in the cryptocurrency market. It helps you stay focused on your investment goals, understand your risk tolerance, and have a clear plan for exit in case the market conditions change. It's important to note that your plan should be flexible and adaptable to the changing market conditions. It's essential to be aware of the market conditions, regulations, and news that can affect the performance of your investments and be prepared to adjust your plan accordingly. In conclusion, to having a clear plan for your investments, it's an essential step in managing risk in the cryptocurrency market. By defining your investment goals, entry and exit strategy, you can make more informed investment decisions and ultimately help you manage risk more effectively. Remember that the market is highly dynamic, so always be prepared to adapt your plan to the changing market conditions. And with that, I think we touched on the most important aspects of risk management in crypto trading. Thank you for listening to our podcasts. I hope that you have learned something new and help you on your trading journey. Have a great trading week ahead. Bye!